China's President Xi urging officials to remain calm in the face of internal and external challenges, signaling that the country may take a measured approach in dealing with U.S. tariffs. That's according to reports out of Beijing. Joining us right now is Ruchir Sharma, Rockefeller International's chairman and Breakout Capital founder and CIO. His latest piece for the Financial Times is titled, "Is China Investable Again?" And Ruchir, lay out your case for this.
Well, my answer, Becky, is that it's always been investable. It's just that what's happened now is that there's been a big shift in sentiment. The big shift in sentiment really started with the DeepSeek announcement, because that sort of showed that China is still very much in the innovation game. And then the other thing, which I had pointed out when we last spoke about my top trends of the year, is that the market had become really very cheap, because after Trump's election, there was almost a fire sale with a lot of pension funds in the U.S. saying that this country is uninvestable. Trump's going to come and he's going to excommunicate China from the rest of the world, and at least the U.S. Listings. So there was a lot of negative narrative on China, and the Chinese market was trading at nearly half the valuation of the U.S. market. So my point here is that there's been a big shift in sentiment. Now, of course, I don't think the fundamentals have changed. I still feel the Chinese economy is likely to keep slowing. Its growth rate is likely to be 2 or 3% on average over the next decade in real terms. But I do feel that the market had become too cheap. And I think that as we look now for more international opportunities, China should very much be in that mix.
Ruchir, I can't help but think back to David Tepper, who joined us at the end of September on Squawk Box and said that he was buying everything China. Was he just very early on this? Did he see this before everybody else?
Well, I can't speak in terms of what obviously, like a great gut instinct for able to do that. But I would say this, though, that let's also be clear what this Chinese rally is about, which is that the original argument for buying China in September was that they're going to stimulate very heavily, and that's going to end up in terms of lifting the market. That didn't really happen. Even now, that's not happened. The rally is still very much concentrated in Chinese tech sector. If you take out the Chinese tech sector, the rest of the Chinese market is really not doing much, even in a strong year like this. The market is virtually flat. The domestic market, which doesn't have many of the tech stocks listed, is virtually flat. So I think that it's a case of being right, maybe for the wrong reason, which is the fact that people were expecting the stimulus to do a lot. Instead, all that's happened is that there's a big sentiment shift triggered by DeepSeek and the fact that people are seeing value, but it's very concentrated as yet in the Chinese tech stocks. Now, I think that should broaden out, because Xi Jinping, I think, is very aware that he needs the private sector to help grow. He's facing the headwinds from the U.S., the uncertainty with the tariffs, so he needs the private sector now. So he's trying to make the private sector more of an ally rather than the hostile attitude that he adopted a few years ago. So that's a change. But so far, the rally has nothing to do with the stimulus. It is very much a sentiment shift triggered by low valuations and the fact that the DeepSeek moment has shifted the perception on China's tech prowess.
Just in terms of the risks that are still at play here, I mean, we think, or you think, I should say, that things are going to be okay with the tariffs and other things that come along. What's the potential for this to get out of hand?
Yeah, I think there's a lot of fear in the marketplace, and even in the U.S. in particular, that how is Trump going to be with China? But everything that I've seen out of Trump, suggests that, there will be some tightening of investment rules or so. But generally, he's been softer on China than even Mexico, Canada, or somewhere else. That's the revealed preference. And the one irony of this moment is that if you look at Trump's first term, the best performing market in the world in his first term was MSCI China. Now, of course, there were other reasons there, but, and Trump did do tariffs and stuff. But overall, there are other factors at play here. So I think people are too obsessed with how Trump's going to be with China and trying to base investment decisions in general on that. We don't know what Trump's exact mind on China is. But so far, the revealed preference is that he's been softer on China than I think that most people would have expected at the outset.
One of the things you wrote about that really surprised me is that you say China now has more than 250 companies with a market capitalization of over $1 billion and free cash flow yield of more than 10%. So 250 in China versus fewer than 150 of those similar companies in the United States. That kind of caught me off guard.
Exactly. So I think that's the kind of research, which in fact even caught me off guard, to be honest, Becky, because I didn't expect China to have so many such companies, which just tells you there's a lot of value creation. And some of these Chinese tech companies, the Tencent, Alibaba, a lot of these companies are throwing out a lot of cash flow now. Now, of course, the difference in China, as I also write in the piece, that in some way the market is more competitive than the US. That if you look at the various industries there, the concentration is a lot less, the competition is a lot more intense. When the US, the big companies tend to dominate across sectors, particularly tech. So that is the irony there, which is not that great maybe for some investors who are looking for moats and stuff. But in general, yeah, that just tells you how much value there is. So again, just going back that, I'd spoken about this last time as well, that I think that my favorite paid trade of the year is, long BYD, short Tesla. I mean, I just feel that that's just telling you about what the valuation gap is. One, even after the rally this year, trades at less than 1/5 the valuation of Tesla, which is BYD, and sells more than twice as many cars as Tesla does. It is growing very fast in many markets. So I think that there are those kind of relative value opportunities to be had there. Now, of course, I don't think that we should bet our entire fortune on China, like in terms of that. But I do feel it needs to be part of the mix, particularly in a year where the international markets are, finding favor again in general. International investing has been dead for 10 to 15 years. It's finding some favor again with people. And so I think China needs to be in the mix. At this stage, of course, I think emerging markets outside of China offer even better value after the rally we have had in China. But this entire approach that I think some pension funds, and other people in the US have taken, or even some large institutions around the world, that China is uninvestable. We can't put any money to work there. I just feel that for the second largest market in the world, that's just too sweeping an approach, and it needs to be much more nuanced than that.